Welcome to Markets Now. I'm Michelle. I work with Ted Seifert of Zaner Ag Hedge, and we ended higher in just about everything except for the soybean complex. And so let's start off there, Ted, talking about soybeans. A few factors, obviously, that could have weighed on that market. It was certainly a risk-off day, and then tariff talk and South American harvest pressure kind of all combined here, didn't they?
Yeah, it really did. Over the weekend, China moved to put some very restrictive tariffs on Canadian canola oil. So the thought is that we're going to be seeing quite a bit more of that Canadian canola oil making its way into the U.S. That put a lot of pressure on the soybean oil market, and that carried over into soybeans themselves. But like you said, I mean, the harvest is rolling along in South America. They're getting their product to port. And that's putting pressure on global soybean values as we absorb that big harvest that's coming out of Brazil, and then a lot of pressure in the overall global economic indicators. The equities markets under a lot of pressure here today. So whenever you have that sort of pressure in equities markets, and you have these global economic concerns, global trade concerns, it seems like soybeans are always the one that take the brunt of that. And so soybeans were under pressure. You could argue that it was actually a pretty decent day for soybeans for the fact that we weren't down quite a bit more than we were.
Yeah.
But part of that might be because we have a USDA WASDE report coming up, and we might be waiting to see what the USDA has to say about that before we really get too excited. We generally do take a bit of a pause or breather in front of reports. So there is that kind of factoring into the mix as well. So lots of things going on here, Michelle.
So let me ask you about the WASDE tomorrow in terms of what we've seen for some of these private estimates. They have been coming down on the Brazil crop. Do you think USDA will make any adjustments lower?
I think for this specific report, the USDA might lower the Brazilian soybean crop just a little bit because of all those private estimates coming in lower. However, you look at the difference between the USDA and Canavi, and it's usually a lot bigger than it is right now. The USDA usually has a much bigger number. And look, I've gone to data users meetings and talked to the USDA about this for the last few years. And basically, I think the best answer that we have for that is that Canavi, being a Brazilian agency that is relatively underfunded, doesn't get a very good grasp about what's going on up in the north. They're better on their traditional areas, but the areas that have been proliferated up in the north, they kind of don't really have a great idea. I think I just have a sneaking suspicion that when all is said and done, and we're talking months from now, I wonder if that Brazilian soybean number is actually going to end up quite a bit higher. But I don't think that happens on this report. I think on this report, they do have, I think, just some justification to lower that number a little bit. So that could be a little bit friendly. I don't see a whole lot of changes in our domestic balance sheet. You can argue exports going up or down really in either direction based on what we're expecting between now and the end of the marketing year. I think it's probably a good time for the USDA to just leave it alone and kind of see how it develops over the next month. But this isn't usually a big report unless we are expecting some major changes in South America, and I don't think that's the case this time.
Gotcha. Okay, so corn and wheat higher. Wheat led the gains here in the feed grain sector. Was that all short covering, or were we trying to put some weather premium in there?
Yeah, I think the best way to say that is that the weather concerns are causing some short covering, and in turn, it ends up looking like weather premium. We have what some forecasters are calling a potential for a historic storm and low pressure system going through the heart or the center of the Midwest and into the plains. With wheat coming out of dormancy with some warmer temperatures recently, it could put it at risk. We might see a lot more precip in some areas than really what we'd want to see right now. So the uncertainty or unknown about the weather and how that might affect the wheat crop is definitely, well, like you said, triggering some short covering and giving the look like we're putting in some weather premium into the market. But you also have to realize that just last week, we put in a contract low for the Chicago wheat contracts. And we were due for a bit of a bounce because of the oversold condition in the market. So this is really kind of serving a bit of a technical purpose. And while we did close, double digit higher in wheat, it wasn't really a breakout of this really short term and shallow uptrend that we've had since putting in that low.
Gotcha. What about the corn market? Did it just follow wheat today? I know we had 71.6 million bushel export inspection figure, but obviously the corn market kind of got pull the other direction with the lower soybean market too.
Right. So corn had a flash sale. Corn had good export inspections, really giving sort of fuel to the idea that the USDA could be justified to increase corn exports once again on the WASDE report. And then you had higher wheat. So a lot of things kind of coming together for corn that were positive. But I got to say, we looked at the commitment to traders report on Friday, and yes, the funds did exit a massive amount of their long position, but they're still really rather long for this time of year. And with the amount of pressure that we were seeing in the equities markets and the amount of concern that we have about the global economy and domestic economy, everything like that, this could have been a much bigger risk off day for corn. You really felt like corn could have been down 8 to 10 cents just based on what was happening in outside markets. And for the fact that it wasn't, I think that was fairly impressive. And you wonder if that's because we have a WASDE report coming up tomorrow and maybe we're just in a holding pattern. This could be a delayed reaction to the pressure that we saw in the equity markets, but at least for the day, I think that was a small win for corn, but a pretty impressive day for corn given everything that had been going on.
Right. And I'm glad you brought up commitment of traders, because as of last Tuesday, the funds had peeled off 118,000 contracts. They've gotten out of some of their length, and the index funds have as well. So what do they do now? Did they add some of those back on last week after the tariff fears kind of went away or not?
Yeah, it certainly feels that way, right? I mean, it was a news-driven exodus. They were getting out because of the uncertainty of how tariffs would go on and where they would go on, and if they would get kicked back for another month, which in effect they actually did for Mexico and Canada. Mexico is obviously the one that we watch very closely when it comes to trade relations and corn. So I think there was just getting that uncertainty out of the way, and I'm going to say a fairly favorable outcome, at least between now and April 2nd, allowed them to come back in and start re-owning some of that corn length again. So I do think they put on, I'm estimating about 25 to 35,000 contracts towards the end of the week, and maybe a little bit of that today as well. But again, I'm watching that global, equities markets, all that very closely, because, if the tariff uncertainty is behind us, that's one thing. But if we are uncertain about the global economy, that's another reason to get that sort of risk off move. So you have a corn market, because of the length that the funds have, or the large speculative position has, that can still be susceptible to a big money move, which would be a long covering sell-off. That is still a risk that's on the table.
What about the cattle market? Impressive day considering the stock market meltdown and the risk off that you talked about. And I know it was a lot due to the higher cash trade, but can we keep holding on here, do you think?
Yeah, that's a really good question, Michelle. I'm worried about what cash will do this week. You feel like Packers, well, they did. They really improved their inventory last week. They had to pay up to do it. That gave us quite a bit of strength at the end of the week. Last week, we've had a very significant bounce off the low. Funds had gotten out of 56,000 contracts on the commitment to traders report, but with the bounce that we saw after last Tuesday, you figure they've gotten back into some of that. So, I don't know. I do feel like with the big sell-off in the equities that we had today, if that continues throughout the week, I think Packers will be very comfortable waiting to see or being very cautious with their bids. I do think there is a potential that cash comes down. I think we have to be a bit worried about our domestic demand if the stock market continues under pressure. So I'd be rather worried that the bounce that we've had in the cattle complex might be coming to an end. And there could be some very significant downside risk, just like we talked about in corn. A lot of that downside risk is coming from outside market fundamentals, and there is concern there. So I do think it's a very good time for cattle producers to be really looking at ways to protect the downside, not necessarily saying we need to sell everything here, but there is that outside market risk. And I'd say the cattle market, along with corn, are some of the most at-risk markets from that. Mainly because of the amount of fund and large speculative length that are in those two markets.
Yeah. All right. So, Ted, the funds are still pretty long in the hog market. Obviously, we've bounced off of the lows here with the Mexican tariff delays. That's allowed that market to rebound. But we're into resistance now. Can we get above those levels?
Yeah, we're in a major resistance. You've got multiple moving averages, multiple longer term moving averages crossing right at the high of the day. And so you figure like this would be a likely area for them to take a pause and possibly for the market to see a little bit of a pullback. But, when we talk about risk off and fears of global economy and speculative length in those markets, I have a little bit of a different view of the hogs market than I do in, say, cattle or corn. And that is because, if we were to see an extended break in equities and we start to feel like we're in a bit of a recession and your American consumer says, I need to spend a little bit less money at the butcher's counter. Well, cheaper cuts of pork might actually be the benefit of that, right? You could see the hog market being uh, a bit of a hedge against a bigger recession. You could argue that some of the speculators are looking at hogs or ownership in hogs for a hedge against that exact scenario. So I don't feel like when we have these days of risk off, even though funds are fairly long the hogs, that they're feeling like they need to run from the hogs. I actually kind of feel the opposite. I think that could be a market where they really they feel safe or want to use that as a hedge. So I've got really mixed feelings on where I think hogs can go from here, especially as you said, we are into some very key resistance here. I do think that we could see a bit of a pullback, but where we go from there, I'm not exactly sure.
Yeah, I agree with you, though. They are a little more recession proof for sure. All right. Thanks so much, Ted Seifert, Zener Ag Hedge. That is Markets Now.